Welcome back, everybody. Today, we're going deep on capital structure.
Ooh, fun.
Yeah, how companies blend debt and equity, to get that funding they need
Right.
for operations and growth and all that.
Mhm.
And you've given me a ton of research on this, which is awesome. A whole textbook chapter on the theory of capital structure.
Yeah, it's a fascinating area.
It really is.
Lots of different perspectives.
Yeah, so let's explore those key theories, and
Ah,
see what's actually happening in the real world. You know what I'm saying?
absolutely.
So, like, the big questions, right? Is there this like perfect mix
Okay.
of debt and equity? Like, does that actually exist?
Yeah, the magic
The
formula.
magic formula.
Yeah.
Why do certain companies, lean towards debt
Mm.
while others, they're like, no way?
Right, right.
And how does all this play out around the world? Because, things aren't the same everywhere.
Not at all. Very different.
So let's unpack this capital structure puzzle.
Okay, sounds good.
Where do we even begin?
Well, I think a good starting point is this idea of a perfect market,
Perfect market. Okay.
which of course
In theory.
only exists in theory.
Yeah, right.
And in that perfect world, you have the Modigliani-Miller theorem.
Okay. Now that sounds complicated.
It sounds complicated, but the idea is actually quite simple.
Okay, break it down for me.
It basically says that in a perfect market, a company's capital structure is relevant.
What? Hold on.
Yeah.
It doesn't matter.
It doesn't matter if they're funded entirely by debt or entirely by equity.
That just doesn't make sense, like in my head.
Right, it seems counterintuitive.
Yeah.
Because, in the real world, we know that debt comes with risks,
Yeah, big risks.
interest payments, the possibility of bankruptcy.
Exactly. Exactly.
Modigliani and Miller, they said, well, if you assume away all those real-world imperfections,
Okay, so it's all based on assumptions.
yeah, assumptions that don't really hold true.
Right.
Like perfect information,
Yeah.
no taxes, no bankruptcy costs.
Okay, so we're talking like a utopia for businesses.
Yeah, in this utopian world, capital structure wouldn't matter.
Interesting. But we don't live in a utopia.
No, we don't.
So then how do those real world imperfections,
Right.
that messiness,
Yes, the messiness.
how does that affect things?
Well, that's where it gets really interesting.
Okay, here we go.
Because as soon as you introduce things like taxes, the whole picture changes.
Okay, taxes. Everyone loves taxes.
Yeah, right.
But how do taxes specifically affect capital structure?
Well, one of the key things to remember is that interest payments on debt are tax deductible.
Okay, wait. So you're saying that taking on more debt could actually lower a company's tax bill?
Exactly.
Wow. Okay, so that's a big incentive to use debt.
It is a big incentive.
Right.
But,
Great.
of course,
Hear that.
there's always a but.
Debt.
Too much debt can increase the risk of financial distress.
Right, because then you've got those huge interest payments looming over you.
Yeah, and if you can't make those payments,
That's bankruptcy territory. And nobody wants that.
nobody wants that.
So it's all about finding that sweet spot,
Right.
that balance
That's the key.
between those tax benefits and the risks of having too much debt.
Yeah, that's the core idea behind the trade-off theory.
Trade-off theory. Okay.
Yeah.
So you're saying debt's not always bad.
No, not at all.
It's about finding that right balance.
Finding that optimal point where the benefits outweigh the risks.
Got it. And I'm guessing that sweet spot's different for every company?
Absolutely.
Right, because every company's different.
Every company's different. They have different risk profiles,
Different industry.
different industries, different growth prospects.
Okay, so let's say we've got two companies.
Okay.
One's like a stable, utility company, tons of infrastructure, like physical stuff.
Right. Tangible assets.
And then you've got like this super fast growing tech startup.
Mm-hmm.
Who do you think would be more comfortable with a higher debt load?
That's a great question. I would say the utility company because they have those tangible assets. They have more predictable cash flow.
Yeah, people need their electricity.
Exactly.
So they can use those assets as collateral if they need to borrow money.
Right. And they're seen as less risky by lenders.
Makes sense. The tech startup, on the other hand, their future's a lot less certain.
Much more uncertain.
So they'd probably be more cautious about taking on a ton of debt.
They'd want to preserve their flexibility.
Exactly. Because what if their whole business model gets disrupted?
Right. Exactly.
Some new technology comes along.
Happens all the time.
So they got to be nimble.
They got to be nimble.
Okay, so we've got this balancing act between debt and equity.
Yeah.
But then there's the whole human element to this.
Right. The behavioral aspect.
Like, what about all these conflicts of interest?
Oh, absolutely. That's where agency theory comes in.
Okay, agency theory. Tell me more.
It basically highlights the potential conflicts
Mm-hmm.
that can arise between the company's managers.
Okay.
the shareholders,
Uh-huh.
and the creditors.
So basically everyone involved.
Pretty much, yeah.
Okay.
Because sometimes, managers might be tempted to prioritize their own interests
Over the company's best interest?
over the shareholders' interests, yeah.
And then the shareholders could do stuff that puts the creditors at risk,
Right, like taking on too much risk.
just to chase those big returns.
Yeah,
So
exactly.
this is where I'm getting a little confused.
Okay.
Wouldn't more debt make these conflicts even worse?
That's a great question.
Like, if you've got a ton of debt hanging over,
Right.
you'd think that would add to the pressure, you know?
It seems that way, but think about it this way. Debt can actually act as a disciplining force.
Oh,
Yeah, when a company has debt obligations, managers have to be more careful.
because they've got to make those interest payments,
Exactly.
no matter what.
No matter what.
So it kind of forces them to make those,
Responsible decisions.
responsible decisions, yeah.
Yeah, that benefit both the shareholders and the creditors.
It's like a system of checks and balances.
It is, in a way.
Yeah, that's really interesting. So debt isn't just about financing.
Right.
It's also about, making sure everyone's on the same page.
Aligning incentives.
Aligning incentives, exactly.
Yeah.
So now we're moving into signaling theory,
Yes, signaling theory.
which I find really fascinating.
It is fascinating.
So paint me a picture. What are we talking about here?
Okay, imagine a company announces they're issuing a bunch of new shares.
Okay, new shares.
How do you think investors would react?
I'd be a little bit, I don't know, concerned.
Concerned, yeah.
Like, why are they suddenly needing all this cash?
Right. Are they struggling?
Yeah, are their projects not doing well?
Exactly. It can send a negative signal.
Yeah, I might be less likely to invest.
Right. But now imagine the company announces they're taking on new debt.
Okay, interesting.
How do you react now?
I think I might be more likely to invest
Okay.
because it seems like they're confident
They're confident, yeah.
about being able to repay that debt.
They're putting their money where their mouth is.
Exactly.
Yeah.
Exactly.
That's signaling theory in a nutshell.
So companies are constantly sending these signals,
All the time.
whether they realize it or not.
Whether they realize it or not.
Every financing decision's like a little clue.
It's like a poker game. Everyone's trying to read each other.
Oh, I love that analogy.
Yeah.
Okay, so we've got trade-off theory,
Yes.
we've got agency theory, we've got signaling theory,
Mhm.
and last but not least,
The pecking order
the
theory.
pecking order theory. What's that all about?
So this theory says that companies have a preferred hierarchy
Mm-hmm.
when it comes to funding.
Okay.
They've got this pecking order, like a ladder.
Okay. A ladder
I like visuals. With the easiest and cheapest sources at the top,
at the top. Okay.
and the most costly and complex at the bottom.
At the bottom, all right?
So at the very top,
The easiest and cheapest.
the easiest and cheapest,
All right.
you've got retained earnings.
Okay, retained earnings, that's the profit.
Yes, the profit that they plow back into the business.
It makes sense. You're using your own money.
Exactly. No need to borrow.
No need to convince investors.
You're in control.
It's like funding a project with your savings account.
Exactly.
Okay, but what happens when a company needs more than just their retained earnings?
Right.
Where do they go next on that pecking order ladder?
Next up is debt.
Debt. Okay.
Yeah, it's generally less costly than issuing new equity.
Okay, why is that?
Well, lenders are primarily concerned with getting their principal back
And the interest.
and the interest, right?
They're not looking for ownership or anything like that?
Right. They don't have the same rights as shareholders.
So there's less information a company has to share
Exactly.
to convince those lenders.
They just want to know you can repay the loan.
Makes sense.
Yeah.
And then at the very bottom of the ladder,
At the bottom, the most expensive and informationally sensitive
dun dun,
is issuing new equity.
equity. Okay.
Yeah, because you're selling ownership stakes in the company.
Right. And that can dilute existing shareholders' control,
Exactly. And it can also send a signal to the market.
like we talked about before.
Exactly.
So companies want to avoid that unless it's absolutely necessary
They'd rather use retained earnings or debt.
to minimize that information asymmetry.
Right? They don't want to spook investors by revealing too much too soon.
I like it. It's strategic.
It's all about strategy.
Okay, so we've got these four main theories trying to explain how companies make these financing decisions.
Hmm.
But now let's get into the real-world factors
Like the nitty-gritty.
that actually influence a company's capital structure. Where do we even begin?
Well, I think a good place to start is company size.
Company size, okay. I would think larger companies would automatically have more debt.
It seems logical.
Right, more assets, more borrowing power.
You'd think so, but it's actually more complex than that.
Oh, How so?
There are conflicting views on how size really influences capital structure.
Okay, give me the different perspectives.
So, on one hand, you have this argument that larger companies are less risky for lenders.
Makes sense. They've got a proven track record.
They've been around longer, they've got more established operations.
And probably more assets they can use as collateral.
Exactly. So, theoretically, they could have higher debt levels.
Because lenders are more comfortable lending to them.
Exactly. But then, on the other hand, larger companies also tend to have easier access to equity markets.
Oh, that's true. They're more recognizable to investors.
Right. They're more likely to be publicly traded.
So they could just issue stock instead of taking on debt.
Exactly. So it's not a clear-cut relationship.
Interesting. So size isn't as straightforward as I thought.
It's one piece of the puzzle, but it's not the whole picture.
Got it. So what about profitability? Does that play a role?
Profitability is definitely a key factor.
And I would imagine that more profitable companies would have an easier time taking on debt.
You'd think so, right?
Yeah,
They've got more resources to make those interest payments.
exactly.
But once again, there are different perspectives on this.
Okay, lay it on me. What are the different views?
The pecking order theory, for example, suggests that profitable companies should actually have lower debt levels.
What? Seriously, I would think it would be the opposite.
It seems counterintuitive,
Yeah.
but the logic here is that profitable companies are generating more internal funds.
Through their operations.
Exactly. They can use those retained earnings to finance their investments and growth.
So they just don't need as much debt.
They have less need for external financing.
Okay, that makes sense from that perspective.
But then you have other theories like the trade-off theory and the free cash flow theory.
Uh-oh, more theories. Hit me.
They argue that profitable companies should actually have higher debt levels.
Okay, now I'm really confused. Why would they say that?
Well, the trade-off theory emphasizes those tax benefits we discussed earlier.
The tax deductibility of interest payments.
Exactly. So the more profitable a company is, the more it can benefit from those tax deductions.
So higher profits make debt more attractive from a tax perspective?
Precisely.
Yeah.
And then the free cash flow theory.
Okay, that one's all about...
It's all about the potential for managers to misuse excess cash.
Ooh, like empire building.
Exactly. They start investing in projects that don't really benefit shareholders
Just to make themselves look good.
or to expand their own power within the company.
So debt becomes a way to kind of rein them in.
It's a corporate governance tool.
Fascinating. So it's like you give them less free cash to play around with.
Exactly. By committing to those regular interest payments,
It forces them to be more disciplined.
it forces them to prioritize investments that will actually generate returns.
That's really interesting. So we've got all these different theories with these contrasting views.
Yeah, it's a bit of a tug of war.
But when we look at the real world, what do we actually see?
Well, if we look at the empirical evidence,
Okay.
it seems like the pecking order theory often holds up pretty well.
So more profits often lead to less debt.
That's what a lot of studies have found, yeah.
Companies prefer to use their internal funds first.
They like to bootstrap their growth.
Interesting. It's like a self-sufficiency thing.
In a way, yeah.
But of course, it's never that simple.
Never that simple.
There are always exceptions.
Always exceptions.
It depends on the industry, the company, the market conditions.
Context is everything.
Context is everything. Okay. So we've talked about size. We've talked about profitability.
Mm-hmm.
What about asset tangibility? How does that play into the mix?
Asset tangibility is a really interesting factor
Okay. Why is that?
because it ties directly into the concept of collateral.
Oh, right. Like if a company needs to borrow money,
Yeah,
they can put up their assets as security.
exactly.
And tangible assets are easier to value, right?
They're easier to value, they're easier to seize if the company defaults.
So lenders feel more comfortable.
More comfortable lending to companies with tangible assets.
So I would think companies with more tangible assets
Hmm.
would have higher debt levels.
That's the general prediction.
And does that actually play out in the real world?
It often does, yeah.
Okay.
There's a pretty strong positive correlation between asset tangibility and leverage.
Right. Makes sense. It's like a safety net for the lender.
Exactly, it reduces their risk.
But are there ever any exceptions to this?
There are always exceptions.
Like what?
Well, for example, in countries with less developed financial systems
All right.
or weaker legal frameworks,
Mhm.
even if a company has tangible assets,
Mm-hmm.
it might be difficult for lenders to actually seize those assets.
If the company defaults.
Right, if the legal system doesn't protect their rights.
So that positive relationship between tangibility and leverage might not be as strong.
It might break down.
It's like that study that showed a negative relationship
Oh, yeah.
between asset tangibility and leverage in Zimbabwe.
Right, because the legal system there made it difficult for lenders to enforce their claims.
Wow, so the legal and institutional environment
Mm-hmm.
can really affect how lenders perceive risk
That's a crucial factor.
and how they value collateral.
Absolutely.
Mm-hmm.
It highlights the fact that even a seemingly straightforward concept like asset tangibility
Mm-hmm.
can have different implications,
Depending on the context.
depending on the context, exactly.
Okay, so another layer of complexity to this capital structure puzzle.
Always another layer.
Always another layer.
Yeah.
Okay, we've covered size, profitability, asset tangibility.
Mm-hmm.
What about a company's age? How does that factor in?
Age is another interesting factor.
Okay, tell me more.
Well, older, more established companies tend to have more access to debt financing.
Because they have that track record.
Exactly. They've proven they can survive.
They've weathered a few storms.
They've weathered the storms. They've demonstrated their ability to generate profits.
Yeah, and they've probably built those relationships with banks.
They have those long-standing relationships.
Over the years?
Which can be very valuable.
Yeah, reputation matters.
Reputation matters a lot.
So, does the research support this idea?
It does, yeah. There's some evidence that older companies tend to use more debt financing.
Okay, so that intuition holds up.
It often does. But as with many things in capital structure,
There are always exceptions.
there are always exceptions.
Right, because some older companies might have built up enough internal funds.
They might not need debt.
I'm like, we're good.
We're self-sufficient.
Yeah, exactly.
Yeah.
Or they might be in mature industries where there aren't a lot of growth opportunities.
So they don't need to borrow as much to fund expansion.
Right, it's all about context.
It always is.
Okay, so we've got size, profitability, asset tangibility, age,
Mm-hmm.
and now the big one, growth prospects.
Growth prospects are a crucial factor.
Because a company's growth potential
Yeah.
can really affect how they think about financing.
It can make or break their strategy.
And once again, we've got those different theories
Yeah, I do.
offering different perspectives.
Always those different perspectives.
Okay, let's hear them.
All right, so one view, often associated with the pecking order theory,
Pecking order, okay.
is that high-growth companies should actually be wary of taking on too much debt.
Wait, why? I would think they'd need capital to fuel their growth.
They do need capital, but remember, debt comes with those fixed interest payments,
Right, those can be a burden.
especially if the company encounters unexpected challenges.
Or if the market suddenly shifts.
Exactly. High-growth companies need to be flexible.
Yeah, they need to be able to adapt
They need to be able to seize new opportunities.
and pivot if something's not working.
Exactly.
So taking on a ton of debt could actually hinder their growth potential.
It could tie their hands.
Right, because they're so vulnerable to those shifts in the market.
They're operating in a more dynamic environment,
And if they take on too much debt, they might not be able to react quickly enough.
and that could lead to failure.
And for a high-growth company, failure can be devastating.
It can stifle innovation.
Yeah, and prevent them from capitalizing on those new opportunities.
Exactly. So it's a balancing act
A delicate balancing act.
between the need for capital and the need for flexibility.
I got it. Now, how do we even measure growth in this context?
That's a great question.
Because there are so many different ways to measure growth.
There are. And the way you measure it can actually affect your conclusions.
Interesting.
So, for example, if you measure growth simply by looking at the growth rate of a company's assets,
Okay.
you might find a positive relationship with leverage.
Because a growing asset base signals to lenders that the company is expanding.
Exactly. They're investing in new projects. They're generating more revenue.
Okay, that makes sense. But what if you measure growth using a metric like the market-to-book ratio,
The market-to-book ratio.
which reflects those market expectations?
Right. It's about future growth potential.
You might actually find a negative relationship with leverage
That's possible, yeah.
because investors might be hesitant to buy shares in a high-growth company that's also loaded up with debt.
They might see it as too risky,
Right, they want that growth potential.
but they also want to manage their risk.
So even how we define and measure growth can influence our understanding of capital structure.
It adds another layer of complexity.
It always does.
It always does.
All right, we've covered size, profitability, asset tangibility, age, growth prospects. Anything else before we move on?
Yeah, we need to talk about taxes.
Taxes. Always a fun topic.
Everyone's favorite.
But seriously, how do taxes affect all this?
Well, as we discussed earlier, interest payments on debt are tax deductible.
Right, which creates an incentive to use debt
Exactly.
because it can lower your overall tax burden.
It can save you money.
So the higher a company's tax rate, the more appealing debt becomes.
That's the general idea.
Okay, but I'm sensing a but coming.
There's always a but.
What's the catch this
Yeah.
time?
Well, measuring a company's effective tax rate
Mm-hmm.
can be tricky.
So it's not always clear how much of an impact taxes are really having.
Right, because there are all these deductions and credit
Loopholes.
loopholes, yeah.
And then there's this thing called non-debt tax shields.
Ah, yes, non-debt tax shields.
Okay, break that down for me.
Basically, these are other ways that companies can reduce their taxable income.
Without relying on debt.
Exactly. Things like depreciation on their equipment.
So it's like another way to get a tax break
Exactly.
without having to take on more debt.
So it adds another layer of complexity.
Another layer. Okay, I'm starting to see the pattern here.
There's always another layer.
But how do those non-debt tax shields affect the relationship between taxes and leverage?
Well, one theory suggests that companies with more non-debt tax shields
Mm-hmm.
should actually have less need for debt financing.
Because they're already getting a tax break.
Exactly.
So why take on more debt and increase your risk?
Makes sense, right? But, of course,
There's always a but.
there's empirical evidence that supports this,
Okay.
but there are also studies that have found a positive correlation.
Wait, so some companies with more non-debt tax shields are actually using more debt.
That's what some studies have found.
That seems counterintuitive.
It does. But one possible explanation is that these companies
Mm-hmm.
often also have a lot of tangible assets.
And we know that tangible assets can make companies more attractive to lenders.
So it might not be the non-debt tax shields themselves,
Mm-hmm.
but rather the underlying asset structure.
That's driving those higher debt levels.
It's a reminder that we always have to be careful about assuming causation.
Right. Correlation doesn't equal causation.
Exactly.
Okay, so taxes and non-debt tax shields add another layer of complexity.
Always another layer.
What about dividend policies?
Ah, dividends.
Do those play a role in all of this?
They can, but like everything else we've talked about,
He's complicated.
is not always straightforward.
Okay, I'm starting to get the sense that not straightforward is the theme of today's episode.
That's a fair assessment.
But how are dividend policies even connected to financing decisions?
Well, first we have to talk about dividend relevancy.
Dividend relevancy. Okay.
There's a long-standing debate in finance
Mm-hmm.
about whether dividend policies actually affect a company's value.
So some people think dividends don't matter.
They argue that investors can create their own homemade dividends.
Homemade dividends, what's that?
It means they can just sell some of their shares if they need cash.
So they don't need the company to pay them dividends.
Exactly.
Interesting. But then other theories say that dividend policies are relevant.
Right. They argue that investors do value dividends.
Okay, why?
Well, for one thing, dividends can signal a company's confidence in their future earnings.
Like they're willing to share their profits with shareholders.
Exactly.
Okay, that makes sense. And then there's this bird in hand theory,
Yes, the bird in hand theory.
which says that investors prefer to receive dividends now
Rather than waiting for potential capital gains later.
because a dividend in hand is a sure thing,
It's a bird in hand.
while future stock price appreciation is uncertain.
It's a risky bet.
So if dividend policies are relevant,
Mm-hmm.
meaning they do affect a company's value,
Right.
then they can indirectly affect capital structure decisions.
They can influence how companies think about their financing mix.
Okay, I see where this is going. But how exactly would a company's dividend policy affect their capital structure?
Well, think about it this way. If a company increases their dividend payments,
Mm-hmm.
they're committing to distributing more of their profits
To shareholders.
to shareholders, right?
Which leaves less money for other things.
Less money for reinvesting in the business.
Or for repaying debt.
Exactly.
So what happens then?
Well, they might need to issue more debt to fund their investments.
Or they might have to cut back on their growth plans
Or they might even need to reduce their debt levels.
just to make sure they can afford those higher dividend payments.
It's all connected.
It's all a balancing act. It's a delicate dance.
So the link between dividend policies and capital structure
Mm-hmm.
isn't always direct,
It's not a one-to-one relationship.
but it can definitely influence a company's overall financing choices.
It's another piece of the puzzle.
Another piece of the
Yeah.
puzzle. All right. So what does the research say?
The research, as always,
Is mixed.
is mixed.
Of course it is.
Some studies have found a positive correlation.
Between dividend payouts and leverage.
Hmm.
Yeah, suggesting that companies that pay higher dividends
Mm.
also tend to use more debt.
like we saw in South Africa,
Right, where increasing dividend payout.
led to higher debt ratios.
Exactly.
But then other studies have found a negative correlation.
Or no correlation at all.
So once again, it depends on the context.
It always depends on the context.
Okay, we've covered a ton of ground here.
We have.
We've explored all those major theories.
From perfect markets to the pecking order.
And all those real-world factors.
In nitty-gritty details.
But before we wrap up, let's zoom out a bit
Okay.
and look at the global perspective.
The big picture.
How does capital structure play out in different parts of the world?
That's a great question, and it's one that researchers have been grappling with for decades.
So are there any clear patterns that emerge?
There are some interesting observations, but it's rarely a simple story.
Yeah, I feel
Like, one of the things we see is that in developed economies, firms tend to rely more on retained earnings.
they use their own money first.
Yeah, that internal funding.
Makes sense.
This has been seen in studies in the US, UK, Japan,
Mm-hmm.
Germany, all those developed economies.
So why would that be? Are those companies just more profitable?
Well, profitability is definitely part of it.
Right.
But there are also these other factors like capital markets in developed economies. They tend to be more efficient and more liquid. So it's easier for companies to raise capital through equity or debt offerings.
So they have more options, but they still choose to use their own funds first.
Often, yeah.
Interesting.
Like one reason could be to avoid those information costs
Right.
and those signaling effects that we talked about with pecking order theory.
They don't want to spook investors by revealing too much information.
And another thing could be corporate governance structures. In developed economies, they tend to be more robust.
More shareholder rights, more transparency.
Exactly. And that can reduce the agency costs associated with debt financing.
So companies might be less worried about managers misusing debt or shareholders taking on too much risk.
Yeah, because there are more checks and balances in place.
Okay, that makes sense. What about developing economies? Any different patterns there?
Yeah, we definitely see some differences.
Like what?
Well, firms in developing economies, they often rely more on external financing.
They're going outside the company.
Yeah, more debt and equity compared to developed economies.
Why is that?
There are a few reasons. One is that capital markets in developing economies are often less developed.
So it's harder for companies to raise money through equity?
It can be more challenging, yeah.
So they have to turn to debt.
And there's also this issue of information asymmetry.
Okay, remind me what that is again?
Basically, it means that investors might have less information
About those companies.
about the companies, yeah,
Especially in developing economies.
where there's less transparency.
So they might be hesitant to invest.
They might demand a higher return to compensate for that risk.
Okay, so that can lead to higher debt levels?
It can make debt more expensive.
Right, because companies have to offer higher interest rates to attract investors.
Exactly.
And then there's also the role of government policies.
Yes, governments can play a big role.
How so?
Well, in some developing countries, governments might actually encourage companies to take on debt.
Really? Why would they do that?
Well, they might see it as a way to stimulate economic growth
Okay, I guess that makes sense.
or to support certain industries.
So you've got those less developed capital markets that higher information asymmetry.
And then the government policies,
Mhm.
all contributing to this greater reliance on external financing.
Yeah, it's a lot to juggle.
It's a complex ecosystem.
Okay, so within developing economies, are there any regional differences?
Absolutely. Every region has its own unique characteristics.
Like what about Africa? We talked about some of the challenges earlier.
Yeah, Africa's got some specific issues that affect capital structure.
Like what?
Well, one big one is this limited availability of long-term debt financing.
Right, we talked about that.
It's hard for companies to get those long-term loans,
And they end up relying on short-term debt.
which can be risky and expensive.
So it's like constantly having to refinance.
Yeah, it creates a lot of uncertainty.
Okay, but despite those challenges,
Mhm.
are there any similarities between capital structure trends in Africa
Yeah,
and those in other developing countries?
there are, actually.
Like what?
Researchers have found that leverage patterns in Africa,
Mm-hmm.
they're actually pretty similar to those in Latin America and Asia.
So they also tend to rely more on external financing
Yeah, and face similar constraints.
in accessing that long-term debt.
So while Africa has its own unique set of challenges,
Mm-hmm.
there are some common themes that run through developing economies.
Okay, that's interesting. So the global picture of capital structure,
Yeah,
it's like this tapestry of different trends and patterns
the mosaic key.
influenced by all these different factors.
A complex interplay of forces.
So there's no one-size-fits-all answer?
Nope, every situation is different.
It's all about understanding the context.
Context is everything.
Okay, so we've explored that global landscape of capital structure. We've seen those different trends and challenges and opportunities.
In different regions.
But before we wrap up, I want to bring it back to a question we touched on earlier.
Okay.
That digital economy. How's that impacting all of this?
Ah, yes, the digital revolution. That's a big one.
It's changing everything.
It's changing everything, and capital structure is no exception.
So are those traditional theories still relevant?
That's the million-dollar question.
Do we need to, rewrite the textbook?
Well, maybe not rewrite it entirely, but we definitely need to update it.
Okay, so what needs updating? Where do those traditional theories fall short?
Well, one area is this concept of asset tangibility.
Right, we talked about that.
In the traditional world, tangible assets have always been king.
Factories, equipment, real estate.
The things you can touch and feel.
But what happens when a company's most valuable assets aren't physical?
Ah, that's the challenge of the digital age.
Yeah, their value's tied up in data,
Algorithm. Online platform.
brand reputation. It's all intangible.
Exactly. So how do you assess the value of a company that primarily exists in the digital realm?
Yeah, and how do you secure collateral when those assets are intangible?
That's a whole new ballgame.
It's like trying to grasp a cloud.
Yeah, exactly.
So are the old rules about asset tangibility and leverage still valid?
Well, that's what everyone's trying to figure out.
Are we throwing them out the window?
I don't think we're throwing them out entirely,
Okay.
but we definitely need to adapt them.
Okay, so how do we adapt? What might those new rules look like?
Well, one possibility is that we start thinking about intangible assets as a legitimate form of collateral.
Okay, so things like user data,
Network
right,
effects.
loyalty.
Those could be considered as security for loans.
So instead of seizing physical assets, a lender could take control of a company's data
Or their user base.
if they default.
It's a radical idea, but it's one that's being explored.
Wow, so the very nature of financing is changing.
It's evolving alongside the digital economy.
Okay, so we're rethinking collateral, but what about those fundamental concepts of debt and equity?
Ah, yes, the building blocks of capital structure.
Are those changing too?
Well, the lines are definitely blurring.
Okay, give me an example.
Take cryptocurrencies, for instance.
Crypto, yeah?
Some cryptocurrencies, like Bitcoin,
Hmm.
they're primarily seen as a store of value.
Like digital gold.
Yeah, like digital gold,
But then you've got other cryptocurrencies.
like Ethereum,
Ethereum, yeah.
which are used to power those decentralized applications
Okay.
and smart contracts, so they function more like a platform.
So where do they fit in? Are they debt, equity, or something else entirely?
That's the big debate.
Yeah, no easy answers there.
And it's not just crypto. We're also seeing the rise of NFTs.
NFTs, those
They're
are
digital tokens that represent ownership of unique assets.
like digital art, virtual real estate.
All sorts of things.
So how do we even think about capital structure when we have these hybrid assets
It's a challenge, for sure.
that don't fit neatly into our existing categories?
We're moving beyond that simple binary of debt and equity.
It's a whole new world.
It's a whole new world.
Yeah, okay, so we're rethinking asset tangibility. We're blurring the lines between debt and equity.
All getting very meta.
But what about those other factors we talked about?
Okay.
Like size, profitability, growth prospects. Do those still matter?
They still matter, but they might be playing out differently.
Okay, how so?
Well, size, for example, might not be as important in the digital world.
Because a small startup with a killer app,
Could suddenly become a giant.
yeah, overnight.
Investors are putting more emphasis on growth potential.
Innovation, network effects.
Those are the new metrics.
So traditional measures of size might not be as relevant.
And profitability. Well, that's always important in the long run.
But we've seen so many startups burning through cash.
Yeah, in the pursuit of growth,
And investors don't seem to mind.
they're betting on the future.
They're playing the long game.
Exactly. And even growth prospects themselves are being redefined.
How so?
Well, those traditional measures of growth, like the growth rate of assets,
Yeah.
they might not capture the dynamics of the digital economy
where growth is driven by things like user adoption.
and network effects.
So we need new ways to measure growth.
We need metrics that reflect the digital reality.
Okay, so we're rethinking asset tangibility, debt and equity, and even growth. What about taxes? Do those still matter?
Taxes will always matter.
But is the digital economy changing the tax game?
It's definitely creating new challenges for tax authorities.
How so?
Well, think about companies that operate in multiple jurisdictions,
Oh, yeah, that's a whole other can of worms.
or companies whose primary assets are intangible.
Right. How do you tax a company that basically exists online?
It's a tough question,
And then you've got cryptocurrencies.
which are designed to operate outside those traditional financial systems.
So it's hard to track them, hard to tax them.
It's a whole new world for tax authorities.
So the entire tax landscape is in flux,
It's evolving rapidly.
which adds another layer of complexity to capital structure decisions.
Yeah, companies are having to navigate uncharted territory.
And investors, too.
Everyone's having to adapt.
It's exciting in a way.
It is exciting. It's a time of great change and innovation.
And it's happening so
It's
fast.
at lightning speed.
Okay, so we've seen how the digital economy is disrupting those traditional capital structure ideas.
Challenging our assumptions.
But I want to go back to Africa.
Okay.
We talked about those unique challenges facing African companies.
But let's dig a little deeper.
What are some of those key factors?
Shaping capital structure decisions in Africa.
Yeah, what are the things we need to understand?
Well, one factor that often comes up is this high cost of capital.
Okay, what do you mean by that?
It means that interest rates are generally higher. It's more expensive for companies to borrow money.
What?
There are a few reasons.
Like what?
One is the perceived risk.
Of investing in African economies.
Yeah, investors might be worried about political instability,
Okay.
currency fluctuations, regulatory uncertainty.
So they demand a higher return.
To compensate for that risk.
It's like a risk premium.
Exactly.
And then there's also the issue of limited long-term financing.
Right, which we talked about earlier,
Companies have to rely on short-term debt
which is more expensive.
and more uncertain.
It's a constant struggle to refinance.
Okay, but are there any positive trends emerging?
There are,
Tell me
actually.
about them.
Well, one is the growing role of private equity and venture capital.
Oh, interesting.
More investors are recognizing the potential of African businesses,
Even with the risks.
even with the risks.
So they're willing to provide funding.
They're seeing the opportunities.
And another positive trend is this focus on financial inclusion.
Yeah, getting more people and businesses access to financial services.
Bank accounts, loans, insurance.
All the essentials.
So that's creating a more diverse and dynamic financial landscape.
It's opening up new possibilities.
Okay, so we've got the cost of capital, the access to finance. Are there any other unique factors that influence capital structure in Africa?
Yeah. There are some cultural and institutional influences as well.
Okay, give me some examples.
Well, in some African cultures, there's this strong aversion to debt.
Really? Why is that?
It might be seen as a sign of weakness.
Or dependence on outsiders.
Yeah, and those cultural norms can affect how companies think about financing
So they might prefer to use internal funds
or seek funding from family and friends.
rather than taking on debt.
It's about maintaining those relationships.
So it's not just about the numbers, it's about social values.
It's a more holistic perspective.
And then on the institutional side, a lot of African countries are trying to improve their corporate governance.
Yeah, they're strengthening those frameworks.
To promote transparency, accountability.
Shareholder rights.
And those efforts can actually have positive implications for capital structure.
They can, because stronger governance can reduce risk for investors.
And lower the cost of capital.
It's a win-win.
So improved governance can lead to more investment.
It's a virtuous cycle.
Okay, so we've explored those unique challenges and opportunities.
In Africa,
But stepping back, what are some of those key lessons we can learn from studying capital structure across the globe?
it's a great question. I think one of the biggest takeaways is that there's no one-size-fits-all approach.
We said that a few times.
It's worth repeating.
Yeah, every company, every market is different.
And capital structure isn't static.
It's constantly evolving.
Yeah, as markets change, as technology advances, as new industries emerge,
So we need to be adaptable.
we need to stay flexible, keep learning.
And capital structure isn't just about the numbers.
It's about people, culture, institutions,
It's about understanding the context.
the broader ecosystem.
And finally, it's not just a theoretical concept. It has real-world implications.
For businesses, for investors, for the economy.
It affects everyone.
It's a powerful force.
So it's a topic worth paying attention to.
It's a topic that deserves our attention.
Okay, so we've explored that global landscape of capital structure, highlighting those diverse trends and challenges and opportunities.
In different regions.
But before we wrap up,
Okay.
I want to bring it back to you, the listener.
All right.
What are some key takeaways you can apply to your own financial decisions
That's a great question.
or your understanding of the business world?
Well, I think one of the most important things to remember is that capital structure is dynamic.
It's not about finding that perfect mix and sticking with it forever.
It's about making strategic choices over time.
As the company evolves, as market conditions change.
You got to be adaptable.
Adaptable, okay. What else?
Understanding those different theories of capital structure, that can give you a framework
For analyzing companies.
making investment decisions.
Like knowing about the trade-off theory,
The pecking order theory.
signaling theory,
All those can help you make sense of a company's financing choices.
and assess their risk.
Exactly.
So it's like having a secret decoder ring
I like that.
for the financial world.
It's all about decoding those signals.
And it's not just about the theories, right?
Yeah.
We also talked about all those factors that can influence capital structure.
Size, profitability, asset structure.
Growth prospects, industry dynamics, the whole economic environment.
It's a complex web of interconnected factors.
So you can't just look at a company's balance sheet in isolation.
You got to understand the story behind the numbers,
The context.
the big picture.
And finally, capital structure isn't just a theory.
Right.
It has real-world consequences.
It affects everyone.
It affects a company's ability to grow, invest, create jobs.
It affects the returns that investors earn.
It even shapes the broader economy.
So it's a topic that matters.
It's a topic that we should all care about.
Even if you're not a finance guru,
Understanding capital structure can give you a deeper understanding of the business world
it can make you a more informed investor.
and a more informed citizen.
Exactly.
So that wraps up our deep dive into capital structure.
We made it.
We covered a lot of ground,
We sure did.
but I hope it's been insightful
I hope it sparked some curiosity.
and maybe even inspired you to learn more.
There's always more to learn.
So to our listener, thank you for joining us.
Thanks for being here.
We hope you've gained some valuable insights.
And that you'll keep exploring the world of finance.
With a curious and critical mind.
Always be questioning, always be learning.
Until next time.
Yeah.
It really is. And it brings us to the final part of our deep dive into capital structure.
Right. It's been quite a journey.
It has. We've gone through a ton.
So much information.
Yeah, but it's been so fascinating.
It really has.
And I want to make sure, as we wrap up, that we bring it all together.
Yeah, distill it down.
For our listener.
Give them some key takeaways.
Yeah, some practical stuff they can actually use.
Absolutely.
So first of all, I think the big lesson here is there's no magic formula.
Right. No one-size-fits-all approach.
When it comes to capital structure.
What works for one company might be a disaster for another.
Exactly. And that's because every company's different.
Different industry, different risk profile.
Different growth prospects, different management team.
It's all about understanding the context.
The context, yeah. So you got to look at the specifics of the situation.
The details matter.
What kind of company is it? What industry are they in? What are their goals?
What are the market conditions?
All of that stuff. And once you have that context, then you can start thinking about those theories.
Right. Those theories provide a framework.
Yeah, a way to make sense of it all.
Like the trade-off theory, for example.
Okay, trade-off theory, remind me.
It's all about balancing the benefits and risks of debt.
Right, finding that sweet spot.
Exactly.
And then we've got the pecking order theory.
Which suggests that companies prefer to use internal funds first.
Because they want to avoid those signaling effects.
You don't want to spook investors.
And then there's signaling theory itself.
Every financing decision sends a signal.
Whether you mean to or not.
It's like a secret language.
Yeah, companies are constantly communicating with the market.
Through their financing choices.
So even if you're not a finance expert,
Yeah.
having a basic understanding of these theories can really help you.
It can make you a more informed investor.
Yeah, and it's not just about the theories, right?
Well-
We also talked about all those other factors.
Right. All those real-world variables.
Company size, profitability, asset structure,
Growth prospects, industry dynamics, the whole economic environment.
and all of those things can interact in complex ways.
It's a dynamic system.
So you can't just look at one piece of the puzzle
You got to see the whole picture
and understand how all those pieces fit together.
and how they're constantly changing.
So it's about being adaptable, being able to adjust your thinking
As new information comes in.
as the world changes.
Because the world of finance is never standing still.
And that brings me to my final point.
Okay.
Capital structure isn't just some abstract concept.
It's not just theory.
It has real-world consequences.
It affects all of us.
It affects how businesses grow, how they invest.
How they create jobs.
It affects the returns that investors get.
And the risks they take.
It even shapes the entire economy.
So it's something we should all care about.
Yeah, even if you're not a finance person.
Understanding capital structure can make you a more informed citizen.
And that's what this deep dive's all about.
It's about empowering people with knowledge.
So they can make better decisions.
And navigate this complex world.
So thank you for joining us on this deep dive into capital structure.
It's been a pleasure.
We hope you've learned something new.
And that you'll continue to explore this fascinating topic.
Until next time.
Stay curious.